Section 2. Let's take a look at economic growth, measurement, and forecasts. Let's start with the GDP. You all know what it is, but there's total GDP. It's often expressed as a percent comparison to prior year or prior quarter. Trends are important, not necessarily a point in time. A point in time can be a flag or a signal, but it's really the trend of what's happening. It's complicated. It includes statistics, estimates. It's not always timely, preliminary and final. Then there's a revised. So if we start with the basics of GDP, it's a primary indicator of the health of a country's economy. If it's healthy and growing, we tend to have low unemployment. Wages increase as business demand labor to meet the growing economy. Builds confidence. People feel good. If it's growing too fast, inflation is a risk. If there's negative growth, less jobs, less production, and it creates negative feelings, which influences how the consumer, you and I, behave as far as spending goes. 2 quarters of negative growth is a recession. So with that is sort of just, you know all of this, I just want to refresh your memory. Let's take a look at the current gross domestic product. Now, why do I have this here? Well, I have it here so that you can understand what makes up the gross domestic product, but also when you start working and understanding strategy of a company and what it might mean for the future, we have to see where it fits. What are the levers that drive things? So as we can see here in the fourth quarter of 20, we were all the way up to $21,479 trillion. 68% of it was consumer spending. 18 was what businesses spent to produce goods and services. Exports were 4%, negative because it reduces it, and 18% is government expenditures. So you can see a good piece of the economy is driven by government spending. That's federal government and state and local. But when we look at 21,479 and compare that, we're still below the fourth quarter of last year and the third quarter of last year. So here we see COVID started, drop down, recovery. So we're starting to come back, but we're still not there. This trend is what companies are using to determine their strategy. When we look at it, and I went back to 2001, is that what we have seen in the past year, we've never seen before. Okay? Look at that from how fast we dropped off, how deep we went, how we recovered, and where we are today. Now, where are we going? Well, it's constant flux because we don't know what's going on with the vaccine, how it's moving, how COVID is spreading, the different strains. But what we've seen, this is from the IMF, and what we can see is that the worldwide growth forecast has actually gone up from October to January to just a little more than 5.25%. The big change has been here in the U.S., where originally in October they were thinking we'd be about 2.75, that the U.S. is now looking at 5. That's quite an increase, but this is what they're seeing. Europe is coming down. China's looking about the same, and Japan better, Latin America better, Europe being sort of that odd person out. But the hopes of the stimulus is going to lift growth prospects, and all of this is dependent on a lot of things coming together. So we need to be careful. When we look at this, and this is from Grant Thornton, and what you can see is here is this dotted line right here is the 2009-2019 growth trend. Okay? And if we actually have a base case scenario versus a delayed, we can actually see that we're falling behind. Okay? So we could get back as we move into 21 to some pre-pandemic level here. Okay, so that's a recovery to that point. But it's going to be a slow, a lot of variables coming into place. What we see is a few stages for the U.S. economy. The first one is a slow growth and low inflation, and that's in the next 1 to 5 months. We moved into the rest of 20. We're going to see some accelerating growth and probably some inflation bumps. But when you're seeing the yields here, 0.75 to 1.25, then 1 to 1.5, and beyond that, I think the forecasts and everything that we're seeing is that relatively low growth, low inflation, keeps rates down. And we're not going to have as much government spending across the world. So it just sort of, there's different stages we're going to be going through. The diverging paths, when we can see how things have moved, when we look East Asia and Pacific, we're seeing growth. Okay? In the advanced economies, nowhere near as fast. And when we see these three, they're even growing slower. But we're really seeing growth in East Asia, South Asia, Eastern Europe before the US and other developed countries. We tend to see these three areas below. But again, these are estimates. These are just to give us a sense of where things are going. Here's again, this comes out of Charles Schwab. It's a little older, but you can still see looking at about a 3%. Just because the IMF went higher doesn't mean everybody is. We're seeing different forecasts by different folks. And that becomes really important, that we're seeing a divergence of opinion of where we're going. We're seeing things from 2% to 5%. That's a huge number. And you can see what the growth is by country. The big ones, of course, are China, India. The emerging markets are really going to drive forward, where the US, Japan, and some of the developed countries will not be growing that far. Take that all within context. This is how the global economy breaks down. 24% the US, 15% in China. India today is only 283, but it's growing incredibly rapidly. So we can see that we have 24% of the GDP, but remember, we only have about 4% of the world's population. So we control a lot more with a lot less people. Now, when you put some of these growth rates together, what you clearly see is that by the time, as this moves ahead, that the US remains essentially stagnant, but when you start applying the math at 8% versus 3%, you're going to see that China and India are clearly going to experience annual growth rates that are higher, but also in gross terms, they will take over to be the leaders. So we'll fall from being the largest to the third, maybe the fourth. And that comes back with these mega trends that we've seen. There's always caution on using the GDP because it's a broad number, and a lot of times I don't think it captures the positive impact of technology, improvement in lifestyles of the population. There's a lot of other alternative measures of how things are being done. And that's going to evolve over your lifetime. We need to be cautious, forecasting and nowcasting. We have so much information coming to us, and the ability to measure certain economic items in literally real time. Okay? And that's changing our understanding and use of information. So how can we adapt and be resilient and come back and take advantage of those? That's what we're going to be looking for in strategies of the companies you'll be working on. Next thing I'd like to take a look at is the employment situation. And this is a big number. Is right now you got about 27 million people impacted. Now we got to look at this in this. We got 10.7 million officially unemployed. Okay, but now there's 7.5 million who are technically considered working, but they have experienced cut in pay in hours, mostly hours. Now there's 3.7 million unemployed but misclassified as employed. 4.9 million dropped out of the labor force. So this is a huge number. This is about 9% of the U.S. population. And that's where this comes in here, is who's in the labor force. We were looking at, when we were getting towards the end of 19, we had just about 63.4% of people in the U.S. over the age of 18 actually participating in the workforce. So that, excluding that, those are people that are retired, those are people that are in school like you and not working, and then there's those who are just out of the workforce. But look what happened with the pandemic. We lost a lot of people out of the workforce. A lot of that mothers staying home, fathers staying home to take care of kids. And we look at this, and right now we're right at that 61.5 level. So we lost a lot of people out of the workforce. Now, when you look at the unemployment rate, it ended up at the 4th for December, it ended up at 6.7%. But remember, we've already lost 5 million people out of the workforce. So we can't look at that in isolation. So we got about 6.7. Now, if you take a broader representative number, and I think this is very important, this is U6, and that includes those unemployed and underemployed. Okay, and look at the number there. We're at 11.7. Okay, so think about that when you look at the unemployment rate is really bigger than the headline number. Okay, and when we look at the recovery path, there's a couple things that we are looking at, if you will. So here is the blue line is the Great Recession, to seeing how things responded. Here is the recession. This is what we've seen already, and now here is the baseline. So it's not till we come back to the pre-recession is going to be into 23, but this is where the trajectory was prior to COVID. So you can see there's a pretty big gap here, and it's going to take a while for us to recover on the employment side. The COVID crisis is hitting what we'll call diverse employees hard, and all employees are struggling, as you can see here. 62% of respondents are concerned with their own mental health, behavioral health, which we talked about previously. Hopefully you watched that video. 60% lack of belonging. Female employees are 1.5 times more likely to be concerned about challenges. Same thing here, people of color, parents, and we're trying to do that, but there's a lot of gaps. So it's really hit our diverse employees hard, which isn't that unexpected, because I'd like to introduce to you this concept of low-wage workforce. These are the people who have been adversely impacted. And when I first saw these numbers, I was shocked. Okay? So what they did is they broke all workers down between 18 and 64. They called 43% are low wage when they sorted them, 56% high. And when you look at the employed versus unemployed, low wage workers tend to be a little bit more unemployed, worked only part of the year. Look at this right there. Average median hourly earnings, 10.22 per hour. That's $17,000 a year. 18,000. So think about that. 44% of American workers make a median of 17,953. That's pretty low. High, when you look at the gap here between high and mid-range, our hourly earnings are 26, 1022. So this is really quite a phenomena that we're seeing, but we have this divergence in the workforce, and of course wealth goes along with that. Low-wage workers tend to be more people of color. Now let's take a look at how growth has happened since 1970. When we take the bottom 50%, in 1970 they made 19,640. Remember, it was only 44% in the other one for 17. That's now up 27,000, 41%. Okay, but then we go to the 50 to 90, was 44, went up to 75. their increase was 72. The top 10 to 1% was up 105. Top 1% was up 250. The top 0.1 up 412. So what we've had is a disproportionate share of income and being at the higher levels. They've gained more than those in the lower. But we're still looking at a very low wage, relatively speaking. Now, some of this comes back to education, and educational attainment. And as you can see, everybody suffered here. But bachelor's degree, which you're working on now, the unemployment is only 4.2%. It did not go up as much. And it has been, even in the Great Recession, it did not go over 5%. So you're in a lucky group. Now, that might say, well, it's a function of education. Well, let's just take a look for a second. College education, which you're doing today, 4-year degree or higher. When I graduated from college in 1977, that's a few years ago, 34% of the American people had a 4-year degree or higher. Think about that. What do you think it is today? Nope, it's 38%. Not much of an increase. By states, it varies from 28 to 50%. In New York State, where we live, much more educated and closer to 50%. When we look at other countries, though, today, Canada, 56%, Japan, 51%, Israel, 50%, Korea, 47%. So what's happened is that in the U.S., we've stayed relatively stagnant with those that are educated over the past 40-some years. So I think that's important, but that's leading us to, that's going back, if we just step back for a second, that these are our low-wage workers, a significant proportion. There's a relationship here. Now that I'm putting into context for both finance and for organization behavior. So that wraps up our economic current situation and forecast. Next thing we're going to take a look at is going to be policy.